Hello and welcome to episode 11 of the Talking Central Banks podcast with me, Karan Merishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about swap lines and how central banking has evolved post the GFC, especially in the context of Section 14 of the Federal Reserve Act. Our guest tonight is Aditi Sahasrabuddhe, who is an assistant professor in political science at Brown. She specializes in international political economy with a focus on geopolitics and global governance, the politics of international finance, central banking, and economic history. Her book, Bankers Trust: How Social Relations Avert Global Financial Collapse, published by Cornell University Press in 25, draws attention to a crucial element behind the resolution of global financial crisis, that is, trust between central bank leaders. Her other work is published or forthcoming in numerous academic journals, Financial Times, and other policy and news outlets. Prior to joining Brown, she was an assistant professor in political science at Wellesley. She received her PhD in government from Cornell and was a global political economy project pre-doctoral fellow at the Mortara Centre for International Studies at Georgetown. Welcome to the show, Aditi.
Hi, Karan. It's nice to be here with you.
My pleasure. So I think starting with Argentina, getting a 20 billion swap line from the Fed New York, I see a lot of parallels here, especially when it comes to Trump with Doge, Milei with essentially doing the same thing in Argentina in today's context, and Bank of England's Montagu Norman and US Fed's Benjamin Strong in the 1920s. Though not technically all four can be compared here, since the gentlemen in today's context are politicians as compared to the latter being central bankers. But in this setting, Aditi, what are your thoughts on the significance of the swap lines, since Norman and Strong are two pivotal characters in your book?
Yeah, this is a really great question and a particularly interesting time, I think, to be talking about swap lines. So, in case your listeners are not very familiar with Norman and Strong, I can just give a little bit of background and then
Yeah,
draw out those parallels a little bit more. So specifically, Norman and Strong were some of the two key sort of pivotal central bank figures in the earlier 20th century, specifically like post-war 1920s, and the way they sort of developed the profession and the idea of central bank cooperation was all focused on their personal relations. They always invoked how important relationships were to central banking and how finance in general was a relational field. And they also had this shared view that sort of national economic stability is inherently tied to international economic stability. But to
right.
manage this, they preferred to sort of always cooperate in this more private and informal way, which was based on this personal relation, rather than trying to get into these more committed and um, various types of arrangements that are far more institutionalized and rules based. And so, since they were some of the earliest characters to set up how modern day central banking works, we see a lot of those parallels continue even in the present day. And we'll be, I know, talking a lot about other crises as well. So there are some really interesting parallels here between Norman and Strong and what we're seeing in the US and with the swap line with Argentina, even though they're more political actors. And the way I see this is essentially the main argument of the book, sort of traveling to newer contexts. And so there's obviously some things where, the technical and technocratic expertise and the sort of specifics of how central banking works may not apply in the same context. But the idea of supporting close compatriots and people we want to support financially to meet various kinds of political and economic goals is certainly something that we're seeing in this case as well. So, one example is again what we see in this current US administration and Argentina and the Milei is this shared ideology between these two leaders. And so that sort of shared preference is essential to creating this stronger relationship between the two leaders. And we can see them now essentially act on that to support one another here, the Trump administration supporting Milei. So, in many ways, this is also not purely an economic decision. The way the swap lines have always been done, for the most part, is they send them to countries where they view them as stable economies, and that's really not how one could look at Argentina's current situation. But
Mm.
what's really interesting is that Scott Bessent and others have even invoked their goal of supporting Milei in the next election. This is sort of bridge loan. So it's not an economic decision, but it is more political and personal. And the personal aspects are certainly some of the important parallels that I would see in what we're seeing now in the discussion of a swap with Argentina, as well as between Norman and Strong. Just one main difference I want to emphasize, and again, the details are still coming out, so I don't really
Mm.
know what the final arrangement might look like. Um, but what seems to be proposed is more of what we would call the ESF from the Treasury, and this is fundamentally quite different to a swap. So it is sort of committing money being available when needed. But unlike the swaps from the Fed in 2008, this is putting American taxpayer money towards Argentina in an unconditional
Right.
way. So in a way, it's almost like an amplified version of the argument in the book, because in the central bank world, that is not really taxpayer money that's going to other countries, even though often it's presented that way. Whereas here we can see politicians use that taxpayer money to support their political counterparts in other parts of the world. But again, we're still sort of watching how this plays out, and I think something really interesting and important to keep an eye on.
Right. Interesting. Coming to the history of the swap lines, Aditi, can you talk more about the historical origins of central bank cooperation in the context of swap lines and how prior crisis management successes and failure played an important role in the GFC swap network?
Yeah, absolutely. And I think the history of this type of cooperation is really, really important in my view to understand what's been happening in the last 15 years. So there's sort of two points I want to emphasize in the historic context. One, which you've already mentioned, which is Section 14 of the Federal Reserve Act. This
Yeah.
is the authority that's granted to the Fed and was granted at its founding in 1913-14, that grants the Fed its authority to conduct its various open market operations. So this includes,
Right.
most of its international activity, including liquidity provision, including the opening of accounts in foreign central banks, which is essential for these interbank transactions. But another thing which I talk about in the book is again not just the laws that enable this, but the ideas and the people behind this setup. So Montague Norman at the Bank of England had written this manifesto in the early 1920s about his vision for central bank cooperation. And two of the things that he'd always emphasized was, cooperation should be a continual thing between independent central banks, even though central bank independence, as we think of it today, wasn't really a formalized institution. Even those ideas sort of originate in his mind. And the other was that it should be sort of continual and ad hoc, and again, in this non committal, non institutional way, but really embarking on a system that allows central banks to avoid committing themselves to these stricter arrangements and take a consistently ad hoc approach to meeting their various needs. And
Right.
we can see many cases of these successes, and we can also see many cases in these successes in which central banks are actively avoiding these institutional mechanisms. So in the 1920s, to meet all the various exchange and liquidity needs that central banks had after the First World War, um, there were opportunities in which a lot of this could have been institutionalized, and central bankers at the time explicitly chose
Mm.
not to. They
Right.
always chose to sort of select who they wanted to, cooperate with and extend money to them. And this was as much political and personal as it was economic. And then we also see this tendency in the 1920s and later in the 1960s of these countries specifically avoiding these institutions. So no one wanted to turn to the League of Nations, which was created with one of its purposes being managing reparations and various debts and economic fallouts from the war. And similarly, in the 1960s, so many central bankers who in the Bank of England, in the US, saying, they pretty much wrote on paper saying the IMF is something we should ideally never use. This is, and this was at the time when it was made for them. So there's always been this uh, restraint in these more institutional and committed programs, and it really helps them exercise their discretion when they need money. So what it helps them do is avoid the time consuming, arduous negotiations, the political concessions that involve the need for sort of government approval, because crises don't always give you a year and 18 months to negotiate these sorts of programs. It's much
Right.
easier to sort of pick up the phone or write a letter in earlier times to make these arrangements very quickly. And this discretion and flexibility um, was essential. The other thing that we've learned is from the failures of their inability to do this in the 1930s Great Depression. And so policymakers during the GFC really learned that. They learned that, the collapse of the money supply, the collapse of credit, both domestically and internationally, was some of the main causes of why that crisis was as bad as it was. And they also had this framework already available through the 1960s swaps, the invoking of the swaps right after 9/11, that they could
Mm.
extend these ad hoc programs to one another. So the flexibility and the ability to act quickly has been really central for central banks to be able to play these critical roles. And in part is in the most important way is a function of this legal authority that's granted to the Fed and other central banks, and this longer term vision of prioritizing ad hoc cooperation for these specific needs.
In the context of Section 14, Aditi, I was very keen on having a perspective on the choice of beneficiary central banks, mostly which, as you understand, were part of G7.
Yeah, and I think part of this is to do with the economic situation, of course, and part of this is to do with the potential political fallout. So, as I mentioned, um, this authority is a grant from Congress, and there's always a fear that Congress will try and take it away, and they've been, not successful, but several attempts at doing that. This general end the Fed movement, but multiple acts that have been tried to that Congress has tried to pass that curbs its independence. And so, where the risk comes from expanding the lines to too many countries is then you have to answer to Congress saying, why do all of these countries need these various types of swap lines? And so the G7 are an easier case to sell politically. These are, long-term economic partners. They're seen as more stable economies and countries in the world. And so, given all of the sort of political and economic relations that have been going on for so long, um, it certainly helps the Fed sell this as a national economic and financial decision in the interest of the US to protect these particular countries given their economic ties. But if they expanded it too much, and there was discussion within the Fed, which we can talk about later, as well as some people
Right.
did want a larger set of countries helped beyond the 14 that were center swap. Um, but a lot of that conversation of, we need to draw this line somewhere because if we start giving it to more countries, even more will ask. And that becomes really difficult down the line to sell to the political authorities that grant the Fed its ability to play this role.
Right. What is the role of central bankers in the area of crisis management, Aditi, that is unique to normal times? Speaking of which, what are the implications of this heightened autonomy for financial governance, both domestic and global, in your perspective, in your opinion?
So I always thought, the role of leaders has mattered across political and economic issue areas. What is unique about crisis management is that sort of what I was talking about in the context of the IMF, which is it takes a long time to, play this lender of last resort role. It takes a long time to negotiate loans, etc. And so, as economic studies, economists have shown that in general, central banks have more discretion because they are technocrats. They have, in many countries, some degree of independence. But there's the additional aspect that in a crisis, you just don't have the time to go through long and difficult and tedious negotiations with other countries. You often need to lend money sort of on the spot overnight. And I'm talking about like tens or even hundreds of billions of dollars. And so
Right.
here, this is where the role of leaders becomes important in two ways. The first is these conversations are extremely sensitive. They involve a lot of people, etc. And so, but that means also there's more veto points. And so, what they try to do is really limit it to a few players within each bank. And they write about this in their own memoirs about how they would, adjudicate who should be in this meeting to keep it informal and off the record, etc. And this is what many of them also shared with me when I talked to them. And so they can exercise a lot more of their own authority when they're not dealing with the more institutional and political constraints of these normal times. The second is, again, central banking just being a central aspect of the governance of finance means it's not, even though mandates are domestic, it has an inherent and implicit international side to it, which means you're not only operating in a void in your own country, you're working with other people who play the same role in other economies. And so, in order to be able to even bring up these conversations, to request that kind of money, you need to know who you're working with. You need to know them pretty
Right.
well to be able to ask the right questions. You need to understand
Mm.
their temperament. Many of them even talked interestingly about, like the strange hours at which some of these conversations were being had,
Mhm.
about dealing with all kinds of like
Yeah.
GI issues and lack of sleep. Like in this case, it just helps to know your counterpart. So I think this is the sort of ad hocery and discretion that central banks tend to enjoy anyway becomes heightened because of this time constraint and the urgency of the kinds of needs that they have to meet. In terms of its implications, I think of it in two ways. So in the domestic sense, um, I've always thought that this is a role that the Fed needed to play and should play, and is a good thing that it
Mm.
did. But it risks in many ways its own position and ability to do so, given that even people who are supportive of this program uh, still call it out for the way in which it was enacted. And so, the backlash towards the Fed, not only for the domestic bailouts, but for those who were paying attention, the international side as well, is bipartisan and is rooted in part along a lack of understanding that many people see this as the use of taxpayer money to bail out foreign governments. But when you see these conversations happen amongst legislators, then that does risk its independence because these are the people who continue to be the ones who decide whether the Fed should have this power to play this role in the first place. So, one domestic sort of implication is the risks for the Fed's own ability to maintain its authority down the line if you upset the people in power that give you that authority if they don't like what you've done or how you've done that.
Right.
And a second thing, at the international level that I think is really interesting is what I find in this book, and this is not unique to the GFC, this is a sort of time and time again problem, is that in these worst crisis situations, it seems like global governance is really in the hands of just a few people, and these are not the
Mm.
people that the whole world has necessarily delegated willingly this authority to. And that becomes a problem because if you have like three or four people sitting in the US who have the power to decide essentially who sinks or who swims in a crisis, that's a huge problem for global governance because there's already so many inequities. And
Mm.
when it's carried out in this particular way, and many of them have even expressed their own sort of pause at this authority that they had after the fact, saying, it's not really the best setup that we had this kind of power. It's a problem for global governance and the stability in general because that means that down the line, the next crisis and its resolution is really in the hands of the people in charge. And if the people in charge don't want to do that job the way it's been done before, then the systemic governance is very fragile. So those are like the two main implications that I found in the US domestic context and also in the international aspect.
Swimming in the same line, Aditi, where do international financial institutions fall in this framework? And what are some of the strengths and shortcomings in your opinion?
So I think this is, like you said, it's all related to this
Mm.
broader point, right? Over the last decades, I mean, since the Bretton Woods conference, we've seen, and even in the interwar period, so many resources, so much time has been put into creating huge institutions for global financial or global governance in general. Like there's a lot of resources and in time invested in this.
Mm.
And still, when we see the worst possible global challenges come up, these institutions are still ill equipped to actually deal with it. A lot of the global inequities that exist are essentially just formalized in the IMF,
Right.
in the World Bank, etc. And so, the West, as I mentioned earlier, in the G7, and not just now, but historically, has always sought to avoid this, which means that these more attractive swap line type arrangements are really saved for the richer, advanced economies. And then the rest
Mm.
of the world is left with far fewer choices, but to look to these more costly alternatives, such as IMF loans, World Bank loans, etc. And so, what it does, in my view, is um, it takes away some of the push to reform these institutions when the richest countries who are not affected by their lack of being their inability and insufficiencies um, are also the ones who have a lot of stake when it comes to these reforms, and so they don't get reformed in the way that they need to be. IMF reforms since 2008 have been really modest in terms of their lending capacity. They have created more and like faster paced loans, but there's so few of those being given out, and they still come up against various problems. And so what it does, I think, is just really embed systemic inequities between countries even further, because now we're sort of divided between those who have access to these cushy swap lines because they're in a certain tier of economies, while others are sort of forced to look to other institutions. I will note the one thing, which is because I've been continuing to do these interviews to understand the financial safety net a little bit more from the perspective
Right.
of policymakers, is that there is a general view that how the IMF and World Bank plays this role has improved, especially in the last decade. Those fears of, the cost on monetary sovereignty and the like, one size fits all conditionality. Those of the 80s and 90s have dissipated to some extent. More and more countries will look to them, to these institutions. But generally, I think the big picture hasn't changed, which is that global governance has, if anything, just become even more separated, more fragmented, and embedded the hierarchies and sort of structural inequalities that have always existed.
Since central banker relations matter here, Aditi, how, in your opinion, do relationships matter among central bankers in managing crisis? The radical uncertainty, as you call it in your book. Why I'm asking this question is because the selection criteria of the G7 central banks is still a pretty nebulous topic. And we did talk about that earlier. If the capital account convertibility argument is accepted as a credible reason to exclude the likes of Reserve Bank of India, People's Bank of China, and the Brazilian central bank, I often wonder how did Argentina manage to qualify for the swap lines?
That's a great question. And I'll start with the radical uncertainty point, and then we can come back to the Argentina, because that's a puzzle that
Right.
even I am still sort of thinking through.
Mm.
So the way I think about it, so the idea of radical uncertainty has been written by multiple scholars, starting with Frank
Right.
Knight and Keynes, in the 20s and 30s. And the idea is that all of the sort of economic models that most of market functioning is based on uh, are what we see as the normal times when things work as they should. So, everything sort of falls into the typical distribution of where it should be. Most outcomes that happen are predictable. We can see them coming with some fair sense of the probability of them happening. Radical
Mm.
uncertainty is when these events that happen are nowhere in the scope of what we see as possible. So we have no probabilistic view of what is going to happen. And this concept was even invoked by officials at the Federal Reserve when they were observing what's happening in markets in 2007, 2008. They themselves said, we can't read these signals the way we normally would. And what that means is,
Mm.
like, all policymakers have to, on some level, as they do all the time, look to the data to see what these indicators are telling people about financial stability, macroeconomic growth, management, all of these various things. But when we're living in a world which those models just don't apply because the
Mm.
system has essentially broken down in a fundamental way, um, those signals don't tell us what they should. It's really hard to really read, which country is actually doing is soundly managed when everyone's in a crisis. And so this is where the
Right.
selectivity of the G7 comes in, because here central bankers will fall back on other heuristics. It could be long-term relations, which is what I look at with their counterparts. Some people would look at these shared ideologies of, well, they're all sort of in the same world of how we govern our economies when it comes to neoliberal policy, central bank independence. All of these things are the alternative indicators of good economic management and efforts towards regaining stability. And so that's where the selection criteria of the G7, in my view, is they fit that older normal mode, and they have the benefit of historical interactions with these countries to know, well, there's a lot at stake if someone doesn't honor an obligation, because these countries have continuing deeply embedded economic and political ties that they rely on sort of the upkeep in a very systematic and significant way. Of course, this is not to say that there's no engagement with China, India, and Brazil. The interesting thing here is that Brazil and India look quite similar in economic terms, and India did not get a swap in 2008 while Brazil did, and Brazil was sort of seen as the cutoff point.
Right.
And one thing I found is that, the governor of the Central Bank of Brazil, Enrique Mareles, I think that's how you say his name. I'm sorry if I've got it wrong. At the time, had spent a lot of his career in the US banking system. He knew the people he was working with much better.
Mm.
Whereas when I got to talk to Governor Subarao, he said, I was new to this profession. There's a way in which central bankers carry themselves and speak to each
Right.
other. And that was just different to the experience of a finance secretary. So, that world in which central bankers are operating is just so fundamentally different, um,
Mm.
that it creates a bit more friction in those necessary conversations. And so this is where the personal relations come back in the Argentina context, but not in the central bank world. So we're just seeing the sort of same application of how personal relations between Besant and Trump and Milei seem to be playing an important part in pushing these two people to really support their friend through bad electoral times, with the stated purpose of trying to get him reelected. They've talked about how this will tide him over through the election to hopefully, improve Argentina's economic means. Um, and these are all things that Argentina would never have done. I think the thing to watch is whether the Fed is asked to get involved. And as far as I know, I don't think it has been yet. I think all the conversation is about the Treasury. But if they bring in the central banks, I think that will be really unique to watch. And I guess I don't want to make too many statements about it since it's a developing story.
Right. And that brings me to secrecy, Aditi. And I think you have talked about that a lot in your book. So, the role of secrecy in financial governance uh, in the past and today, what do you think are the nuances? I mean, how has this role of secrecy evolved over the years?
Mm.
And how much has it changed in that period when you have covered it in your book?
Yeah, so I think I see secrecy as both a necessary evil and then just an evil to an extent, but and also, it plays a very effective role here. So secrecy has been central to central bank cooperation and central banking in general for the longest time. It was again, partly, before it was institutionalized at the creation of the Bank for International Settlements in Basel. That's partly why the ad hocery of the 1920s took place in the way it is. Central bankers would travel in disguise and under aliases. They didn't want people to know what they were doing. For some reasons, it's because, and I show this in the book and in other researches, they're actively in the 1920s, not now, I should say,
Right.
cooking the books. They are reporting gold holdings and reserves and flows that are not actually happening. They write their contracts in a way where they can each hide behind economic problems, to sort of window dress, but in an essentially fraudulent way. This was how a lot of the problems of the 1920s then manifested later, is because we were not seeing true data. So that's a kind of secrecy that is just like not good. It's not, and it happened through the 1960s as well. But then there's this second element of, as I'm sure all your listeners know, markets react to any indication of any policy decision.
Right.
And until it's been settled, I think it's important that that is kept quiet, because we don't know what the policy decision might be like, and you don't ever want to see any kind of extensive overreaction from, investors and the broader equity stock markets, etc., that are responding to any movement or indication of some major decision. Where it becomes a problem today, because again, like, the secrecy was still central to how the swaps were conducted in 2008, not in the fraudulent ways of the 1920s, but still,
Mm.
even people within the Fed, within the ECB, didn't know of the swap lines till they were announced. So they were secret not only outside of the institution, but even within it, given how significant it was, for two reasons. One is they didn't know if it would work. This was essentially seen as an experimental project. Ben Bernanke even writes in his book, which I quote in my book, which is saying, I don't want to oversell this till we know how it operates. So
Right.
there is that element to which secrecy matters. But then when we see, which I talked about earlier, this political backlash to the central banks playing their roles, that's when the secrecy could become a problem, because it's a sort of clearly at odds with the general democratic principles that the public and politicians, public especially, want to see, which is transparency, which is accountability. And when they learn after the fact, again, without the technical knowledge of what a swap is, that New Zealand is getting $9 billion and other countries are getting X amount of money, and even the domestic bailouts, but most of the population doesn't benefit in that way. That's when
Right.
the secrecy can become a problem, because again, it becomes a problem for politics and for political stability, and again, the central bank's ability to continue doing its role, to the extent that if it's inciting some sort of backlash.
Preeti, what are some of the domestic and international political implications of the argument in the book? And what has changed since the GFC in the global swap framework that needs more attention today in your assessment?
Yeah, so I'll reiterate the short implications that I had discussed before, but then expand
Yeah.
into how they look today, because I think they still matter, but in a sort of different context.
Mm.
So the
Mm.
first, again, is the risks to the Fed's own independence, the general bipartisan pushback against a lot of the
Mm.
policies that were undertaken in 2008 and 9, that risks the Fed's own authority to keep playing this role. So that's one domestic implication. And the second is a sort of the fragility of global governance, the fact that, the entire financial system and who is helped and who isn't is in the hands of just a few people. These are some of the more international implications. Um, when a few people can decide, again, who is supported through a crisis and who isn't, and that essentially shows the instability of global financial governance, and the risks that we face in any future crisis if the right people, quote unquote, are not in charge in the next crisis. We may not see a sort of swift response as we have this time. And so what this looks like today is, I think, really interesting. And I think those implications still matter. In fact, if anything, in an even more acute way. So we're living in this time across the world of extreme political polarization. We're seeing a general inward shift across the board in many large economies and democracies, where we've seen growing distrust amongst public and even politicians, in experts, in institutions, in elites, etc. And so the initial pushback was in a very different environment where the risks to the Fed were still quite limited. There were efforts to curb its authority. But today, when we see the discussions against central banks across the world, the ECB has suffered similar sort of pushback, the Bank of England, in this very politicized environment, in this environment of low trust in institutions and experts. I think those risks become even more real today. So that's the first domestic consideration when we think of the domestic political landscape across the world. And then in the international side, we've seen two developments. One is, again, states have started to look inwards increasingly. And this means that, if there's pressures on central banks on how they conduct their activities, their international activities especially, um, then the global financial safety net is also at risk for other countries that have for a long time relied on these swap lines. In addition to that, we're seeing new geopolitical tensions that are now manifesting, that have been manifesting in the economy in different ways. So not only are we seeing the sort of current trade wars, etc., but we're also seeing, and the tariffs. China has been creating its own swap network as pitched as a rival for countries that are generally like dissatisfied with the US-led governance order. We've seen a general um, concern that international cooperation is not going to be upheld when we have so much more nativism in the largest economies. And so again, all the risks of being reliant on one country, on a few people,
Mm.
are heightened when the geopolitical environment is actually not conducive to cooperation. One of the things
Right.
that really facilitated cooperation in 2008 compared to the Great Depression is that these countries were not at war with each other, which in the way
Mm.
that they were just coming out of a war in the 1920s and 30s. Those disagreements over reparations were still ongoing. There's a lot of
Right.
animosity between countries. So now that we see that kind of environment, even though it's not like outright war, there is a lot of rivalry and tension and conflict, um, that risks the stability of cooperation. But then I think there's the
Mm.
other sort of flip side, which maybe I think about to feel more hopeful, is that perhaps to the extent that central banks can preserve their independence, or their integrity in how they conduct themselves, and we've seen that across the board also, then maybe we
Mm.
can at least know that we can rely on this discretionary technocratic governance, even though on the
Right.
political side we see more
Mm.
isolation and nativism.
I think the Chinese swaps are more of trade credits, Aditi, if I'm not wrong, if you compare them with what the US Fed provides. But in any case, can you explain why a single swap event occurred at the start of COVID-19? I reckon that the quantum was just $450 billion in May 2020, as compared to the GFC when there were two major tranches
Mhm.
amounting to over $680
Yeah.
billion. And this is Aditi, part of my own research. I am actually sure major emerging markets would have protected themselves from safe haven capital flight with spot dollars during the time, which wasn't really made available to them. Would have been a great help at the time when markets were being impacted because after the COVID-19.
Yeah, I think the way I have interpreted that is in two sort of main developments that I've seen. The first is that I think since 2008, especially countries that were sort of declined the swap in the past, or tried
Mm.
to avoid more costly arrangements, etc., have
Mm.
invested quite substantially. Of course, not all, but many in East Asia, Latin America, etc., in increased self-insurance capacity. And I'm not like, not just in terms of their reserve holdings, but their like reduced dependence on foreign currency debt. More of their markets and interactions and transactions are denominated increasingly in local currencies rather than dollars. And so they've sort of done a lot to not have that same degree of reliance on the US system in general. I don't, and I should also say, I don't mean this is any sort of significant de-dollarization that challenges
Right.
the dollar's role, but certainly a lesson was learned amongst those countries that this is something that they did seem to rely on a lot in 2008. They also probably know that they may not be able to rely on it in the event of a future crisis. And so a lot of the last 15 years have been invested, I know at least in Latin America and parts of East Asia, is to sort of increase their own local currency debt markets and access
Right.
that type of liquidity. And the second is, I think one aspect of this is that the most of the G7, so there's 6 countries that have standing swap lines with the US that have had continued access to dollar liquidity since 2013. And these are the countries,
Mm.
again, which are probably most affected by any kind of drying up of global dollar liquidity. And so maybe the fact that a lot of it was already in place and in motion maybe helped minimize the shock events. And then, of course, there's the FEMA repurchase agreements that were opened up by
Right.
the Treasury for countries that have accounts in New York. So um, they were not swap lines, which is again the sort of the top tier what every country wants, but it was certainly a second best alternative and a way to make dollar liquidity accessible to more countries. But on this point, what was really interesting is that in the Fed's own discussions about the standing swaps from between 2009 and 2013, and I think even in the years after, there was always a discussion of enhancing this framework and maybe including more countries. So the Fed was also very divided on this. And again, I think, selling it politically is one of the main obstacles to doing much more. But essentially, there wasn't complete unanimity on limiting the standing swaps to only 6 countries. There was always discussions of even adding more than the 14 that had been given swaps in the last crisis. And I think um, even the conversation of the FEMA repos had been had earlier. There was just no event that required opening that window until 2020. But I think the fact that those conversations had been had in the decade before made it very
Mm.
easy to open up dollar access in different ways.
Right. Taking our discussion back to your book, Aditi, in the context of chapter 3, which is springtime to Bretton Woods, I think the world moving towards the US dollar from gold standards fundamentally changed the Fed's relationship with the global central banking community. This was because because post Bretton Woods, the Fed effectively became the central bank of the world,
Mm.
kind of usurping the role of what the IMF was supposed to do. And in my opinion, I think that is probably the reason why the SDRs never really had a shot at being the penultimate reserve asset on central banking balance sheets. What do you think in the context of the emergence of swap lines, given this background?
Yeah, I think there's a few things going on, and I think certainly, as you said, the Fed's inordinate position that it took
Mm,
on in 1945 is a
right.
major obstacle to the SDR sort of failing
Mm,
to launch in the way that some people envisioned. I think part of it was
right.
throughout the Bretton Woods discussions, US officials resisted any kind of international currency. And not partly again to sort of, maintain their own influence and power, but also partly because I think it was seen at the time that more veto players and who decides and maintains the stability of the currency was a sort of risk. And as we've learned from, say, Charles Kindleberger, it helps to have sort of one supporting political entity as backing up this
Mm,
institution. And I think perhaps the fact
mm,
that we see so much division even in how the IMF functions is a reflection of that same disagreement in terms of developing an international currency. Another thing that
right.
I found in the archival work that I did was the people at the Fed in the late 50s and 60s took an active role in changing their relationship with the G10 and the IMF and Europe in general, which is for the longest time, no Fed official went to the Basel meetings in an official capacity. Sometimes they go in as a sort of viewer or a visitor, but they didn't have an official attendance in the same way until Charles Coombs, who was at the foreign office in the New York Fed, where he thought, we need to be doing more in terms of getting to know our foreign counterparts and engaging in this more active international cooperation. And so there were initially these swap lines created within Basel, but what the European economy, which didn't include the Fed, and it became very clear that they needed the dollar because, again, the US was the hub and the rest of the world's currencies were the spokes,
Mm.
which was then the dollar being tied to gold. And so I think a combination of the US just came out of World War II much stronger, had the ability to influence those negotiations in a way that put the dollar in its position in exchange for these other security guarantees and creating markets for countries that needed to rebuild and enact various types of post-war reconstruction. But also in the 1960s, the very active efforts by New York Fed officials to start participating in the BIS in an official capacity was really
Mm.
important here. And so these, like I find in the 1920s case and the GFC, these sort of personal and informal ties played an important role in the creation of the initial Fed swap network, which was also to another 14 countries at the time.
Mm.
And again, these personal relations and trust were sort of an important facilitator, or its absence, a major obstacle to creating these arrangements. But countries ultimately needed dollars, and the US had the ability to run the show on its own. So I think certainly there's an important factor in the Fed and the US dollar's position in preventing any kind of international currency ever coming up, like the SDR that you mentioned. So
So this time is a different
Mhm.
argument has kind of emerged as a self-fulfilling prophecy in the global financial system. And I think you talk about this in detail in your book. Uh, in my view, when Reinhard and Rogoff introduced this concept during the GFC containment period, there was a significant body of work already proving this hypothesis.
Mm.
As human greed will always trump regulations at all times. Now that the Fed knows that financial cycles are a reality, just as the economic cycles are, what exactly is the belief system behind having an exclusive swap club, as you like to define it, when stresses are not really limited to just a few economies?
That's a great question. And I think something that
Mm.
I've been very interested in understanding more, again, also partly why what motivated this book is why
Mm.
just six countries. This seems to be a global problem, but
Yeah.
not a very global solution. So I
Mm.
think this is a really important question that you've asked.
Mm.
So as I mentioned earlier, the Fed FOMC has been quite divided in the last 15 years
Right.
on expanding the swap network. There was some interesting conversations being had about including Mexico. Other people talked about including even more emerging markets in the standing lines in the initial swap framework.
Right.
Some people thought, and this is the show of goodwill. This is the way in which countries need to be uh, supported through global dollar liquidity crises, etc.
Right.
And there's others who are just worried about selling this politically, selling this to the people who give the authority to do it. And so uh, those are the sort of tendencies that seem to be coming up. The interesting thing that really struck me in the conversations that were first had, this is before the standing swaps were even discussed, but really what happens after the GFC is there was a conversation of having something put in place that was more permanent, because the fear was everyone who did all of the work in 2007 and 8 may not be in office in the next crisis, and they literally said like 10 to 12 years out, which is almost to the date of COVID. And so that's partly why these standing lines were put in place, which is it's much easier to expand something that already exists, especially to countries that have had this experience with the Fed before, than it would be to start from scratch. So they needed to sort of lay that foundation. And I think the reason why the Fed has been able to maintain this system and keep this swap network quite exclusive to 6 countries that have a standing line, 14 that have had temporary access in 2008 and 2020, is because again having that framework in place makes it easier to then negotiate more down the line. And I
Right.
think there are discussions, of course, with people, I should say, who have now left the FOMC, but are when I talk to them reflecting on some of
Mm.
these aspects, is they do think that in the next big crisis, they will have to think about a larger set of emerging markets because of how much some countries have grown and how much of a bigger footprint they might be having in like international banking and the financial sector. So I think again having that foundation in place might make that a little bit more easy, rather than having no swap networks in place at all, instead.
Right. Finally, Aditi, you say that macro variables are not dependable markers of crisis. And as an economist, I do not agree with that. But can you elaborate on this, especially in the context of the butterfly effect that you talk about in the book?
Yeah, so I should say, like, when I
Mm.
say macro variables are not dependable, I wouldn't say so much as they don't tell us that were in bad times, of course,
Mm.
or wouldn't challenge any of the like a huge literature on causal predictors of crisis that we've seen. I think there's a lot
Mm.
that I agree with in there. So my
Mm.
argument instead would be that once we're in a crisis, and this is something someone at the Bank of England had said to me, and it's in the book, which is, the idea of a lender of last resort is to lend freely, at a high penalty rate against good collateral. But when everyone's in a
Yeah.
crisis, you don't have good collateral by definition. That is the
Mm.
entire idea, of what the crisis is. So I think again that's one aspect of, it's really hard to read these indicators because what we're reading is a longer term data and trajectory, but what a country looks like at that time when those models are a little bit more iffy. Um, I
Mm.
think where the risks come in. And even people like Eugene Farmer on the record saying, I couldn't explain what was happening. This was completely outside of all of our models, 2008. The crisis that happened was not the crisis people anticipated, which was some sort of global imbalances crisis,
Right.
not a banking crisis across
Mm.
the world. The second thing
Mm.
is also, which when I talked about, the models being off, is the way that the system had evolved really takes away the risk from its source and where it tends to manifest. So when we think about how, like, ordinary people's loans and mortgages were tied up in these securities markets that are spread across the world and then are being traded by various entities, that's where the butterfly effect comes in. Is, it's a few people starting to default on homes in certain neighborhoods in the US, which then became a bigger problem, became a crisis for the whole world, right? And that's because of how many different markets and models are intertwined with each other, and that
Right.
a problem in one can very quickly be transmitted throughout these various systems, given how interlinked
Mm.
various markets are and how widespread from sources of various risks and triggers of threat, are sort of transmitted through these markets. So I think that's where I would sort of add in that point, which is, again, I wouldn't say that markets don't tell us where, markers of macro variables don't tell us we're in a crisis, but I think that they can't tell us the extent of the problem, given that we are in a situation where those models were not written for that kind of climate. So that would be my response. But it's a
Mm.
really good question, and I know I'm going to be thinking about it for the rest of the day to really puzzle through it a little bit more.
I mean, I can defend this from an economist point of view that with the
Mm,
emergence of the nowcasting models that we
mm,
now follow, so I think that has solved a lot of problems as far as the black box is concerned when real-time data was not really
mm,
made available during COVID and things were going haywire. But I think nowcasting by using certain high-frequency variables was able to predict well. And so when we were sort of analyzing the economy during COVID and its aftermath, then we were decently close to
Mm,
what the actual numbers were, if I talk about in hindsight. So I think, in some sense, if you do not have access to high frequency data, then yes, the variables won't really tell you where you are. But there are certain high frequency data sets, for example,
mm,
crude purchases by India, for example, and the sale of petroleum was an extremely good variable as far as assessing domestic consumption and GST collection was concerned.
mm,
Even though it has an indirect bearing on GST, but still it was a pretty good indicator of that. So yes, I know that there is a big difference of opinion among economists that what is the best approach during crisis. But I think some economic models were successful in as barometers of where exactly we were during a crisis like COVID. But still, it's
mm.
quite a nebulous topic, and a lot of discussion is required in that regard.
Absolutely. And I think just to your point that
Mm,
these developments are really
mm,
significant and phenomenal. And my
mm.
read of that is I think we do have a lot more information and understanding
Absolutely.
of complex systems today. And a lot of that is
Mm.
because of learning from when we didn't. And so I think
Yeah.
that's how we can think about it. So definitely, yeah, there's
Mm.
so much progress has been made in the kinds of data we have access to and how we can interpret
Right.
movements for sure.
Absolutely. Well, that's all I have for today, Aditi. It was indeed a pleasure to have you on the show.
Thank you so much, Karan. It was a pleasure to talk with you a bit more today.
Thank you very much, Aditi.